Hey, what's going on, guys? All right, so today I'm going to talk with you about why multifamily buildings are so powerful. So what I did here is I built a big graph. I'm not going to give you a math lesson, but I'm going to break it down in nice, simple form. It's real numbers on a real building of ours, how they perform over time. So I just wanted to explain to people. I get asked a lot how it works, so I thought this was a good way to do it. So basically, this is how it works over a long period of time. A few things to note. This is our actual loan amount, 1.19 million on a 16 unit in Saskatoon, Canada. Value with the purchase price was 1.4 million, and it was a 2.62% interest rate on a 35-year amortization. So it's all real numbers. I broke everything down, year 1 through 35. And that's the amortization of the loan. Cash flow, that's your net income. So we're assuming that there's been a reserve fund put in place already and all your expenses have been paid. And this is the cash flow paid out to investors monthly. So $2,000 a month goes to the pool of investors. So that's what that is. Your mortgage paid down, that's your actual loan amount. Value with appreciation, it's all 2%. Everything on here is 2%, so if you wanted to go 1%, you could, and it would still be almost equally as powerful. Cumulative cash flow. Again, it's all just based on assuming that the building hasn't been sold. This is how much would have been paid out. Equity value. This is the amount of the value sitting in equity, basically. So your appreciation minus your mortgage pay down. So I'll get into it here. Year one, your cash flow would be about 24,000. Mortgage pay down is 1.9. Value with appreciation is 1.4. You've had 24,000 paid out and you have 210,000 sitting in equity. So that's basically your down payment, the 210,000. We'll go to year 5. 26,000 is the cash flow that's been paid out, or that's being paid out every single year. Mortgage pay down is 1.05 million. So your tenants have paid that down. That's one thing. That's one of the most powerful things about real estate is over time your tenants pay the mortgage, so it just creates that spread, opens the margins up, and when you go to sell it, it's awesome. Value with appreciation, you're at 1.54 million. Cumulative cash flow is 96,000. That's what's been paid out. Equity value, you have 500,000 sitting in there already. Year 10, you're at 29,000 in annual cash flow. Mortgage pay down. Now your tenants have paid your loan down to under $1 million. Value with appreciation is 1.7 million. So your cumulative cash flow that's been paid out is 225,000, and the equity value is about 775,000. So even on year 10, you start seeing a really large spread. Like, that's very impressive for 10 years. So what we did is, with our investors, we offered per $100,000 invested in this building, they get a 20% stake of everything from cash flow to the mortgage pay down to the appreciation. So if we sold anywhere in here, like, you'd have 775,000 that you'd get 20% of. So then we'll actually skip to year 20 here. So 35,000 is what's being paid out annually to investors. Mortgage pay down is 600,000. That's what the loan amount is sitting at. Value with appreciation, you're over 2 million now, and you've had $500,000 paid out over the 20 years, and you have $1.5 million in equity sitting in the building. So if we sold, say you were 40 years old when you invested with us, now you're 60 and we sold the building, you'd get a check for $300,000, and that is RRSP eligible. So that means that you can invest, if you have RRSPs that are just sitting there not getting any returns after your management fees and everything, you can put it in a building like this, and like, that's a way better vehicle than mutual funds or anything like that, or any other vehicle. We'll skip to year 35 now. Actually, we'll go to year 30. So 43,000 annually paid out, annually paid out. Mortgage pay down, you're down to 186,000. Value with appreciation is 2.53 million. Cumulative cash flow is 706,000. That's what's been paid out to investors. Equity value is $2.3 million. And then year 35, the loan has been paid off. We were paying 51,000 in annual debt servicing, so that transfers over to cash flow. Value with appreciation is 2.79 million. Cumulative cash flow is 1 million. That's what's been paid out, and equity value is 2.8. So, like, you have a $2.8 million building with no loan on it. That's extremely powerful. And then, like, So this is like, again, this is an extremely conservative building. We wouldn't even buy this building, to be honest with you. It's just like a normal performing building. So what we look for is buildings that we can actually drive the rents. So we're looking for buildings where the owners are, say, baby boomers looking to retire. They're sick of dealing with tenants, tired landlords, and they haven't kept up on rents. They haven't kept up on maintenance of the building. So what we do is we buy it under market value. We go in, we raise the rents to market rents, which increases our cash flow. And we can do that just by cleaning up the building. And a lot of the times, like this building, actually, there was one tenant paying $600 a month for a 2-bedroom on the second floor. And market rents in that area are $900 a month. That's what our target is. So like that's huge. Times that by 16 units. And like they're not all $300 spreads, but even $100 times 16 is a big deal. So anyways, you drive the cash flow. So we're actually projecting in year 5 to 7, we'll be up around that 50,000 annual cash flow mark. Remember, a reserve is in place for all your maintenance. So all these numbers just compound. And then how that translates over to the value of the building. Multifamily buildings aren't valued like single family homes, like comparable basis. They're actually valued as a business. So the more cash it generates, the higher the value of the building. So basically, even in a few years, like even in year 2, we should be up around 1.6 million. And then shortly after that, we should be 1.7 million. So, and that's what our projections are, and it's been verified by the banks and everybody. So that actually makes all this compound. Like it's just extremely powerful, you guys. So these numbers are just huge, and then it affects your cumulative cash flow, your equity value, everything. And the investors participate in all of that. They get a chunk of everything. So monthly payments, all the way to the sale, like extremely powerful. But anyways, I hope you guys like that. And if you did, hit the subscribe button, and I'll see you guys later. See you on the next one.